Hello, I'm Natalie MacDonald and you're watching Sydney Direct. Now, as the Greek tragedy continues to plague the single currency, I'm asking Dr. Shane Oliver at AMP Capital whether or not the Australian markets care and what should happen if Greece leaves the euro. Shane, as always, a pleasure to see you. Thank you very much for joining us today.
Thank you. My pleasure.
Okay, so Greece. Interestingly, the Aussie dollar has actually felt the weight of those Greek debt negotiations. Walk us through some of the market response here.
Well, I guess Greece is sort of going on in the background, then you've got these other issues going on at the same time, but the Aussie dollar has stayed down at relatively low levels. So whenever there's uncertainty about the global economy, investors tend to stay away from the Aussie dollar. So that's how the impact is playing out. And it's also occurring at a time when the Reserve Bank has been cutting interest rates, commodity prices have remained relatively soft, and there's still debate about when the US will move towards higher interest rates. So all of those things have been weighing on the Aussie dollar.
The domestic share market as well has also appeared to be a touch sensitive really to this never-ending Greek tragedy, you could call it almost. But really, economically speaking, what is actually the connection here really?
Well, the connection is very, very minor. Of course, Greece is a very, very small economy, even in the context of Europe, and Australian trade with Greece is virtually non-existent. So in that sense, it doesn't really matter. What happens, though, is when there's news about Greece, that affects confidence regarding the Eurozone, and that, of course, affects Australia, because although Eurozone is not our biggest trading partner, China is, and of course, China's biggest export market is the Eurozone. So that's the impact there. So we have seen days where there's bad news on Greece cause a bit of weakness in our market at the open, and vice versa when there's good news. By and large, though, it's having nowhere near the impact it had back in 2010, 2011, 2012. And of course, right now, there's been some positives for the Australian share market in the form of lower interest rates, the lower Aussie dollars feeding through. That's helping to some degree. Relatively good profit results, some takeovers and so on. So as a result, the market overall has been fairly resilient.
So if we consider then the knock-on effect on the markets globally, and I guess subsequently Australia, should Greece leave the exit? Or I guess the first question really is are you part of that faction that believes a Grexit, as it's being called, is more an inevitability than anything?
I certainly don't see it as inevitable. One could argue maybe it's desirable because the Greek economy is radically different to most of the rest of Europe. So in that sense, it's probably not in their longer term interest to be in the euro. But by the same token, I think the preference I get, the information I get is that the Greeks do want to stay in. 70% of Greeks say they want to stay in. And you can see the current government, Syriza, bending over backwards almost, not quite, but they have retreated a long way from where they were at the time of the election in terms of putting up compromises towards the Eurozone to try and get an extension to their agreement. So my feeling is that it's not inevitable, and the odds are they're probably going to stay in, and I do think that we're probably going to see some sort of deal, at least an interim deal, but more importantly a longer term deal regarding support for Greece continuing.
Well, what then if Greece does choose to stay in the euro, or if it becomes possible that it can stay in the euro? Is this simply going to become something cyclical? As you already mentioned, we had it in 2010, 11, 12. Could we see a similar scenario in another 2-3 years' time?
It's certainly possible. The reality is that Greek debt levels are unsustainably high. You're running at about 170% of Greek GDP. By contrast, in Australia, to put a plug in for Australia, it's about 25% of GDP, and the Eurozone average is about 100% of GDP. So their debt level is too high on that basis. Flip side, though, is that you can argue, well, it's not that onerous for them because their interest rates they're paying are incredibly low. They have no debt repayment due till 2023. I think what will happen here is that you'll have some form of agreement from the rest of Europe to reduce the size of the primary budget surplus that Greece has to run. That's the surplus after interest payments. And if that's the case, I think I'd have a bit more confidence they'll start to get under control over time, because the reason their debt to GDP ratio is blown out is because their economy has collapsed. If they can stop the collapse in their economy, GDP starts growing again, then their debt ratio will come down to a more sustainable basis. So yes, there is that risk. It could resurface in a couple of years' time, but by the same token, I think there are ways that can avoid that.
Well, always looking to plug the Australian GDP versus anywhere else. Shane, as always, thank you so much for your comments today. Thank you.
My pleasure. My pleasure. Thank you.
The Dukascopy TV team will continue to keep you updated on this story as it unveils. For now, though, it's goodbye from me.